Hi, this is Michael Carlin, president of Henry & Horn Wealth Management with your third quarter 2018 market outlook, joined as always by the fabulous Stefan Dye. Stefan?
Hello. Thanks for having me. Happy to be here.
Well, thanks for being here. Is it like this is your first Arizona summer? So you feeling it at this point? 115 every day?
I actually like it. You know, we got here in January and people said, I said how wonderful it is. We came from Newport Beach, California, and people said, you're going to hate the summer. And I said, oh, okay, I know. And I had all these elaborate plans to deal with the heat. And we got to May, and I thought, I kind of like it. And the whole dry heat thing is a big deal. I went to Texas, and it was 80 degrees and humid, and I was sweating and hated it. And I wanted to get back to 100 and dry.
Wow.
So now we have 115 and a little bit more humid, but I still, I think it's nice. I don't hate it here. I actually like it. Yeah, it's wonderful.
I really wasn't sure what you were going to say.
No. You know what else I like about it is everywhere you go, you always can talk about the weather and the humidity to everybody all the time. No matter how many times you've spoken with them about it, it's just what you talk about here. But what about you? You just got back from a trip to California. How was that?
Well, it's a lot of work. It's a lot of work. Legoland is it's like the young stepchild of Disney. Which is to say that it's everything's a little bit worse. It's still good. Kids like it just as much as Disney, but for parents, we see the differences. I would say that kids loved it. I'll never go again. How's that?
So, dad and two girls. That's not an easy trip, but they loved it.
Very easy for the girls.
Yeah,
smooth, easy, terrific. But I'm glad we're back.
Yeah. Did you tell them you're never going back?
I said we're going to go someplace else next time, and they seemed okay with that.
All right. Wonderful. Wonderful.
I don't know. Hey, can we do some slides?
Let's do some slides. We can talk about investments if you like, markets, forecasts, review.
I like that. Okay. All right. So first 6 months of 2018, it was interesting in that we finally saw the resurgence of small cap. Small cap did really well, and conventional wisdom is small cap did well because there was a real tilt towards America first. Those that are going to benefit the most from tax reform, those that are going to do well with the way the U.S. dollar moved in the first half of the year. There were a lot of tailwinds that pushed and propelled small cap. First 6 months of the year up almost 8%, whereas international markets, again, Europe, Japan, certainly all other aspects of everything in the Europe with everything they're dealing with Brexit. We saw that negative 2.8 the first 6 months. Emerging markets down almost 7 after having a great 2017. And as you look to kind of set the table for what we're looking at in the third quarter, we start to see the winds are changing a little bit with the market.
Yeah, it looks like it. The trends over 1 year and 6 months don't align over most of the major markets. So if you look at 6 months, you see foreign developed markets are down, emerging markets are down, China is down, Germany's down, UK is down, the S&P 500 is down. The only place you see any growth is in small caps, like you're talking about in technology. If you look a little bit longer, if you look at 1 year trends, you still see a lot of the things are up, but they're only up a little bit.
Right.
The developed markets are up 3-4%. S&P 500's up 5-6%.
Right.
So I think a lot of technicians start to get worried if the trends are down over 1 year, and people are starting to get concerned. But small caps, like you're talking about, outperforming, and technology too, although Twitter is being crushed today. Not sure when listeners are going to hear this, but Twitter crushed today and Facebook just destroyed yesterday.
Worst, most market cap lost in a day ever for Facebook. That hurts.
Facebook lost the same amount of market cap as total market cap for Netflix, almost.
That's awful.
In 1 day.
I got a great chart. The bull and bear market cycle. It's kind of like the cyclical bull, cyclical bear. And it's one of my favorites from this quarter. And what it shows is you can really appreciate the magnitude of the run that we've had from 2009 to today. And if you look back, you can see the cycles of when the market went down in 2007, 2008, .com. You got to go back to 87, before that 1980. But as you look at this chart, you can't help but be prepared for what is shaping up as something where it looks like we're indeed headed towards a very difficult market cycle, because you can see very clearly from this chart that the second longest run in bull market history, in stock market history, it's 112 months in duration, market up 325%. We finally have beat the long run after the Great Depression, which was a 60-month, 323% cumulative return. So listen, people are always asking, how much longer? You get a chart like this, there's only one market to compare it to, and that's the dot-com bubble.
Right.
And so that's the debate we have to have, is can a part of the market push us to dot-com levels? And if that's the case, maybe we have another 20 to 30 months.
Maybe we do. I don't know. I can say that we're going to have a bear market. I know that. I can't say when it's going to be.
Right.
And can it run for a couple of years? I don't know. But we do call it a market cycle, an economic cycle, for a reason. That's because it goes up and then it comes down. It can't go up forever. So we're wise to continue to talk about it, wise to continue to watch it.
Yeah, we're trying to do is we're trying to figure out every day, every week, every quarter, given what the data is presented to us, is it time for us to get more defensive? And one of the things we're looking at is the lack of breadth in the market, meaning that there's certain aspects and areas of the market that are doing well, information technology, energy, healthcare. Those areas of the market have led us for the first 6 months of the year. They've actually performed well. Nothing better than IT, that technology area, where you've got staples, telecom, not staples, the office supply, consumer staples,
right.
Telecoms, financials, real estate sector, which has performed a little bit better as of late, and utilities also rebounded a little bit better, but all of those are down for the year. Right. So this isn't the kind of market where all areas of the market are moving higher. That's just not what we're looking at.
No, what you've done, and rightfully so, is zoomed in. We talked about developing markets and all the markets all over the world down. So when we zoom into U.S. markets, we look at the different sectors, and IT is up enough to make it seem like it's not as bad as it would be otherwise. Right. If IT were sort of flat, then the S&P 500 would be down
massively negative.
Yeah, massively negative. IT's been really pulling it up.
Right. And when we take a step back, we really need to get a sense for what we're going to see from the rest of the world. Are we seeing the kind of robust global growth that's going to push us for the rest of the year and into 2019? And if you look at global consensus for this year is that the globe's supposed to go at 3.2%. And that's for the whole of 2018. That's the forecast. If you look at the forecast for 2019, it's supposed to go at 3.1%. So what you know is that analysts are expecting less growth next year. And a big component of that we know is the tax cuts and job acts. That's helped corporate earnings quite a bit. And and as we look through this and we get the data recently that shows that the U.S. GDP up 4% for the quarter. This is the best number we've had since 2014.
Right.
You have Trump saying, no, he wants to see 4% GDP growth for the remainder of the year. It flies in the face of what the analysts are forecasting, and we're starting to see a real dispersion between what people believe and what investor behavior is starting to translate.
Yeah, and we spent some time, I think, last month or maybe it was the month before, talking about how analysts get forecasts of earnings wrong because they tend to forecast in a straight line.
Right.
The same thing's going to happen with GDP growth numbers. They're going to continue to grow, and they're coming in really strong. They look great. But when they do start to turn down, whenever that may be, and I don't think that's going to be soon, but when they do, they'll start to disappoint because the projections will continue to be high.
Exactly. And some of our clients were retired CFOs, controllers of big publicly traded corporations, and they understand this very well. They're not looking into the future when they're making forecasts, and they're sharing their forecasts with Wall Street analysts and saying, here's how we're going to earn less money next year.
By the way, it's going to get bad from here.
They don't do that.
No.
They don't do that. And they're looking squarely at their own marketing forecasts, business plans, growth targets, where they're helping make those decisions about how they're going to grow next year, and they're not necessarily looking at the overall economy. And thus, there's always a surprise.
Of course, and they're human. They tend to forecast in a straight line. That's just what humans do.
Humans do that.
Yeah.
So humans also look at the economic surprise indexes.
Yeah.
And we like economic surprise indexes. We like it. And what's interesting to us, S&P put out a pretty good report that we grabbed here, a great chart, which shows if you look at the economic surprise index for the United States, the Eurozone, emerging markets, in the whole global economy, all of the surprise indices, again, we're trying to get a sense for forward-looking economic numbers and trying to get an understanding for where economic numbers may go, but all the surprise indices are going down.
Yep.
None more so than in Europe.
Right.
And you can't help but believe that Brexit, which is coming up, is still undefined in terms of how that's going to work.
Yep.
Italy, whose government bonds are now being priced as if there's going to be a default, which, by the way, they seem to have enough cash, and so it doesn't seem very likely that will happen. But you got Italy, you've got Brexit, you have tariff, a potential tariff. At one point, there was a discussion which seems to have waned a little bit, where the Trump administration said and suggested that they were going to put a huge tariff on European autos that may affect the price here in the United States as much as $7,000 a car.
Wow.
So with all of those headwinds facing the UK economy, it's not a surprise to see that their economic surprise indexes are down the most. But it's surprising to me that there's global unison.
Yeah, and so this economic surprise index talks a little bit about what we were just talking about. So when data comes in less than expected, the economic surprise index starts to go down. And when data comes in better than expected, the surprise index goes up. So we've got unbelievably high expectations. And we've had terrific growth, but the growth hasn't been as high as expectations all across the board, just like you're talking about. So this could mean, if you think about what's going in the future, it could be that the surprises start first before the data turns and starts to follow the surprises. But at least expectations are going to have to come down.
Right,
Yeah.
and because valuations are a little screwy. So let's look at international. Let's look at all areas of publicly traded stocks and start with the S&P 500. If you look at the S&P 500, price to book as, again, a measure where you're looking at the share price versus the book value of the company to get a sense for whether or not it's expensive.
Right.
Price to book, albeit not perfect, but a good indicator for us to pay attention to, is so close to all-time highs for the S&P 500. The measure is at 3.27 and 3.45, being as high as it can get.
Right.
The 15-year average price to book is 2.5, and it could be as low as 1.6, which is, if you're looking at it in a scale, and the graphs that I'm looking at show it really well, you can see, if it were a thermometer, it's almost at the top. And if I'm looking for value on a price to book scale shows up well for the international market, where we're currently at a 1.6 and the 15-year average is 1.7.
Right.
We're less than average. Emerging markets, which had, again, the great year last year, rough start to the year, price to book down to 1.6, average is 1.7. You can see some reasonable valuations there. Where the U.S. market, it looks so expensive. So it on a valuation scale, it's hard to justify the prices when you look at price to book. But at the same time, there's just this overwhelming feeling that the quality is here in the United States. In that that we're the economy that has the better surprise index, we're the economy that has the best GDP, we're the economy that has the favorable tax reform, which has helped corporate earnings. So we should have the best price. We should have the highest price to book, and this is really the only safe haven. And international and emerging markets seem to be thrown out right now.
Yeah, we're also the economy, the stock market with the most momentum. And as you know,
Right.
momentum over the last 12 months, the indexes or the stocks that have performed the best tend to perform better. For the last 12 months, then they tend to perform better over the next 12. So everything looks good for the United States. stocks, economy, except for on a valuation basis where it's just really expensive.
Right.
We also have a lot of people in the United States have what we call a home country bias, where people all over the world tend to invest far more in their country than they do in other countries. I saw something really interesting yesterday where there's I'd call it a home region bias, where,
Really?
yeah, in California, investors allocate a lot more heavily to technology. On the eastern seaboard around New York, they allocate a lot more heavily to financials.
Right.
Whereas in Michigan, they'll allocate more heavily to manufacturing in a significant way. So we have a significant...
Texas more oil?
in Texas, Oklahoma, Louisiana.
Gotta be. Wow.
Absolutely. So it's interesting how people sort of go with what they know and where they are. But for those of us who have a value bias, we start to look all over the world, especially emerging markets. And then my concern becomes, when I do that, though, is currency risk.
Right.
So the dollar has been rallying against foreign currencies, which has pushed emerging markets in dollar terms down even more.
Right.
So trying to predict what the dollar is going to do is a little difficult to do, but it's something we want to pay close attention to.
Yeah.
Or when we take our foreign investments, we can hedge the currency risk. Is something to really think about.
I got to mention what you may or may not have seen with the China currency. Have you seen how far down, how much cheaper Chinese currency has gotten since the trade war started?
Absolutely.
It's astounding.
Yeah.
It's astounding. So, and again, that's an unintended consequence of tariff discussions in a way that China, in some ways, is winning an aspect of the tariff.
The currency is down, the stock is down, growth is slowing, and there are many who believe that the big story, and maybe we'll do this next month or the month after, about growth in China, because growth in China has slowed, and it could be contagious.
Yeah, market's only down 20% in China.
Yeah.
So that's it so far. One of the things, again, we need to continually keep our finger on the pulse of is consumer spending, because in the United States, consumer spending still drives the economy. We are a consumption-based economy. Consumption is about 70% of our total economic output here in the United States. And it appears as though workers are living within their means. So if you look at personal consumption expenditures on a year-over-year change basis, and you lay that over with what paychecks are really adding up to, again, what people are taking in versus spending, there's been a really nice link where as paychecks have gone up, spending's gone up. The only little concern that I have is that there's been a rash of an increase. I say a rash, an increase of consumer borrowing that has come up, and it has actually exceeded here recently what the paycheck number looks like. So I'm a little concerned about the consumer spending number. It's been good. Paychecks have been good, but I'm seeing a little bit of a slowing down there, and that leads us into, and we're going to spend a little bit more time on our special section this quarter on inflation, but inflation expectations are getting on the high side.
Yeah. Yeah, they're getting higher, and I'm happy to see people are making more money. I'm happy to see they're spending appropriate amounts relative to the additional money they're making. And I don't know if it was last quarter or the one before, we talked a lot about the Federal Reserve and interest rates, and a lot of what they're watching is inflation, and especially wage inflation.
Yeah,
that's
you got to watch it.
They have to, and that's when they will take the punch bowl away from the party when inflation gets out of control. And
you're seeing inflation specifically related to tariff, and I don't think enough people are talking about it. But we've got a couple of really nice charts, and that if you look at aluminum, lumber, wood, steel, three specific commodities that have been directly impacted by the tariffs, those prices are up in some cases 25-30%.
Yeah.
You want to talk about inflation. Those are fundamental components of building blocks of so many different industries and parts of the economy.
Yeah.
And what's also nice is we've got another chart where there were seven tariff dates. Seven tariff dates. There were 7 dates with which tariff was mentioned and actions were taken this year. And if you look, each of those 7 dates that tariffs were mentioned, January 22nd, March 23rd, April 2nd, market's down every time.
Yeah. Yeah.
The market hates the tariffs. We're fighting through it, because corporate earnings are good, but you're seeing it lumber, aluminum, steel, those prices are surging. It's being mentioned in the market, or again, from the administration, the market's reacting negatively to it. The tariff situation is starting to hurt.
Yeah, we talked about this before about narrative economics, about how stories move markets. And so one of the big stories that markets are moving on right now is the tariff story. And when you see aluminum, lumber and wood, steel moving up as much as 8-10% over 3-month periods.
Right.
That's moving fast, and
right.
we're going to start seeing it reflected in the prices we pay for building houses and
right.
buying cars and everyday items. It's coming.
Building solar panels, building and constructing solar power plants. All of that stuff very much impacted. And we turn our focus to interest rates. We want to mention this. We mentioned it once or twice. Let's just keep mentioning it. Is that there have been 9 times that the yield curve has gotten negative. And each of those 9 times the yield curve's gotten negative, it's correctly signaled a recession. Now,
it's a perfect track record since 1955.
What else has a perfect track record since 1955?
Well, my batting average is...
Come on now.
Okay.
Come on
maybe
now.
not. Yeah.
No, but I mean, listen, it's something we need to pay attention to, because this spread difference between the short part of the Treasury and the 10-year Treasury got as low as 20 basis points, which is to say 0.2%, which is to say very flat. And we're getting remarkably close to it. And if you look through, there are these recession dates, again, going back from 1955 to today, and every single one of them was led by this inverted or negatively sloped yield curve. Now, it doesn't always mean that as soon as you get a negative sloping yield curve, the next day the market goes down. I think the average is 8 months or so.
About 8 months.
Yeah.
Yeah.
I mean, because I think that it's not understood enough, because people they hear a negative sloping yield curve, and they think that it's an immediate thing or it happens beforehand, but that's not necessarily the case.
Not in the economy, but in stock markets, sometimes it does. So over the last 9 times we've seen an inverted yield curve, we've also had a bear market follow, just as we've had an economic recession. But I shouldn't say follow, because 2 of the times the yield curve inverted, the bear market began before the yield curve inverted.
Right.
And so since we care a lot about the economy, we also care, I'd say even more, about our portfolios. So we're on high alert when we start to get near an inverted yield curve, knowing that 2 of the last 9 times the bear market started at levels similar to where we are today.
Right.
Especially when we see the stock market down, like we discussed earlier, all over the world over the last 6 months.
Right. Well, and so let's do some of the key takeaways. I know we've got so many graphs and charts. We could sink a battleship, probably.
You should tell listeners how they can get these charts.
Sure?
I mean, if I were in your seat, listeners, I would want to see these charts. Michael takes a ton of time to put them together. They tell a wonderful story, and
who doesn't want the charts? Everybody wants the charts.
I love the charts.
I love the charts. So you send us an email. You can send us an email at either Michael C. at hh-wm or Stefan D. at hh-wm.com. Send us an email. Give us a call. We're happy to zip it out to you. Let's do the key takeaways, because we've got a couple of charts that we'll breeze through, because I do want to spend some time on the inflation. Inflation is, I think it's one of your favorite topics.
You
love it.
I'm not sure if I love it more than you do.
No.
I'd say that we both love it. You wrote a blog about inflation recently, which makes you the king of inflation writers right now.
I just like to keep it private.
Listeners, see Michael's blog on inflation and retirement. It was terrific.
Thank you. We believe investors are right to be worried about the interest rate environment. In that the interest rate environment is again, with that negative sloping yield curve, with low rates getting higher, because we know that the Fed, they've increased interest rates 7 consecutive times. We believe it's very likely one's coming in September, maybe another in December. So with the Fed moving the short part of the yield curve, it's unlikely to us that the 10-year and the longer part of the yield curve moves higher, which means things get flatter. Things can start to get a little bit negative. You now understand why we're a little concerned about negative yield curve. Again, because we just discussed that, it's an accurate predictor of what the economy is going to do. So we think investors are right to be a bit worried about rates here.
Absolutely, we're watching the rates. We could not watch the rates more closely. Last week there was an interesting move up in yields in Chinese bonds, which pulled up yields in U.S. bonds a little bit on the 10-year. And there was a moment where we felt like maybe the curve was going to steepen again because it was going to rise on the long end.
Yeah.
Turned back down over the course of the next day or two. So now again we sort of feel like, well, maybe that's not going to happen. We're going to stay flat
right.
on the long end at the 10-year level, and the Fed is telling us for sure we're going to be raising rates.
Right.
Yeah.
It'd have to be something shocking to get them to change, and that leads us into, the other key takeaways from this quarter is that you can look at analyst expectations across the board, and many are predicting growth to be very good for 2018, but 2019 starts to moderate a little bit.
Right.
And we continue to talk about this wild card, and that is, will there be another policy, something fiscally done from the White House that's going to end up giving us another boost to the economy? And to me, I think that the one thing that stands out is an infrastructure package. Because if we got some kind of a $1 trillion, at one point Trump mentioned a $2 trillion infrastructure package, and again, that's something that's developed and issued to help your roads, bridges, airports, things like that. That infrastructure package may really provide a huge boost, which may make us rethink our 2019 earnings expectations, because right now it looks like it's moderating.
Yeah, I'm a super proponent of infrastructure packages, and we keep talking about China, but we've talked in the past about how Chinese growth is such an important part of global growth over the last couple of years, and they're investing in infrastructure incredibly. There's something that they're doing they call the Belt and Road Initiative, where they're building infrastructure to access markets far away from themselves. It's the largest infrastructure project in the history of the world. Now, they're having to borrow a lot of money to do it, and there's some concerns about their debt.
We talked about that. It's massive debt.
The debt's incredible, and there's some concerns about it. But I do think investing in infrastructure is great. It's great now. It puts money into the system. It puts people to work, and it gives us the opportunity to thrive in the future. I would love to see an infrastructure package.
So again, we're not assuming that it's going to happen. So our base expectation is that returns will be moderate over the next 5 years, but there's substantial risk to the market at these levels. We've highlighted it. We've provided you the data. We're talking about it, and again, our clients, know that what we do is we proactively review these things so that as we see changes coming, we're going to do our best to get you out of the way or get you to safe water as much as we can.
That's right. We want to access as much of the growth when it comes and protect from the downside when it comes. So we position portfolios in a way that we don't know what's going to happen in the future. So we're trying to protect from all situations and take advantage of the growth.
We just want it to be perfect. That's it.
Just Goldilocks.
We need to have Elizabeth do some kind of like a sound graphic for special breakdown, like Thunderbolt or something.
That would be terrific.
Something fun, like a horn, like something. I guess somebody's like walking into the.
She's over there nodding. I think she's going to do that for us next time. Yeah.
Okay, so special breakdown, inflation. The question is it becoming a concern? And we're going to take a quick step back before we dive into it, because inflation, again, the cost of living going up every year. We got that. Very few investors walk into our conference room understanding the problem that inflation can potentially hold for their finances. They just don't think about it. They think about fees, or they think about returns and prior performance. Yeah, they think about a lot. They think about Trump. They think about the administration. But inflation, I'm telling you, no one ever comes into the office worried about it. Now, some of our longstanding clients now understand it's a problem, but no one comes into the office panicked about inflation.
No, they don't. What I hear about inflation is you making fun of me talking about it all the time.
You love it.
And so I've been asking people lately because I do tend to focus on inflation a lot. And let me tell you why. Why do we save money? We save money for the benefit of our future self and our future family. So we're sacrificing our current consumption, our current self for future benefit. And then what do? We invest it so that it will have even more benefit in the future than it would have in the present. But inflation is going to happen between now and the future. And so my return, what really matters is how much more than inflation I get.
100%.
And I've been doing this for the last week and a half and asking very smart people who are in financial services what they believe reasonable expectations for future returns, inflation adjusted,
and what
are.
they say.
Well, they typically give me a reasonable number, not inflation adjusted.
Right.
Because they're not accounting for inflation.
Right.
And these are people who should know.
Right.
They're just not thinking about it that way.
It's crazy.
Prices go up over time.
Right.
Yeah.
And if you don't make sure that you have an investment that can grow significantly more than inflation, and in accounting for taxes too, you're not getting ahead of the game. So wages have been rising. We talked a little bit about paychecks. They haven't. It's nice. We do want to see a little bit of wage inflation, but not too much because it's a huge component of inflation. The challenge is that we saw the CPI numbers. Again, the government headline inflation numbers, which came out at 2.8.
2.8.
And I think again, there's many that are expecting. I'm trying to think of who wrote the report, but they're expecting to see us get through that 3% inflation number.
Right.
Which again is a trend, that's something that we have to share, because there's certain investments that are going to do well and others that won't in a higher inflation world.
That's right. And keep in mind that the Federal Reserve's target is between 2 and 2.5. So when you go over that, they want to take away the punch bowl.
Well, and I got a little history lesson, and I think I can help explain why people don't think about inflation.
Well, wonderful. Sure.
It's in the chart.
Oh.
I wish I could just show that. You can see the chart, though. So the chart, here's the chart. The chart will show you from 1870 to today. And it's going to show you there are periods of time where we had inflation, which is the vast majority of the time. Again, cost of living going up, the prices going up over time. And there are certain pockets where we've had negative inflation or deflation. We haven't had one since the financial crisis, but before that, you can go back to, it's the 1950s, then we had any kind of deflation. So number one, the people that are alive today and that are consuming on a regular basis, they may have seen a deflationary environment, but probably not. Again, 2007, 2008, that was a component, but not a lot of people really felt it. It was very short-lived.
Right.
And it was very moderate.
Right.
And if you go back, the 10-year average inflation number we've had is 1.64%. So we've had a decade where no one has even mentioned the word inflation. I think that's a huge component. It has really been since the 1980s and the 1970s that we have had to even consider or think about inflation, because those rates of inflation were in the 13, 14% range. In the 70s, it was in the 12% range. You got to go before that to get inflation that really ran out of control. Looks like here sometime in the early to mid 1940s. We haven't had runaway inflation. We haven't had deflation. But what we have had is a period of almost nothing. The cost of living really not moving up a whole heck of a lot. So it's lulled people to sleep.
Yeah, what I'm struck by looking at this, and listeners, you should see this chart. It's very interesting, but it goes back to 1870. And what you see is a lot of cycling between periods of inflation and deflation, and significant deflationary periods.
Right. In the early late 1800s?
Leading all the way up into really the 1940s, ending in sort of 1940, 1950.
Federal Reserve.
The Federal Reserve said, we don't want to allow this kind of inflation. We want to stabilize the economy. And since then, it's basically been a story of inflation, whether low or high, rising and peaking in 1980, like Michael's talking about, and then falling and falling and falling till we get to today. It appears to be rising again a little bit.
Right.
Yeah.
So we want to be the first to educate you on it. I wish we could do trivia questions, Colin, because the average inflation rate from 1870 to today, 2.5%.
Yep.
But the average inflation rate from World War II to today, 3.8.
Yep.
Okay. So we've been averaging, again, 1.6. Look for different numbers to come.
Yeah.
And if you look at certain areas of the market and the economy, there are areas where we've seen some high inflation, specifically energy, which is a year over year, inflation's up 8%. Transportation, year over year, up 4.1%. Housing, up 3.4%. Again, there are areas of the economy where we're not seeing inflation, but there are where we're already, it's massive. And the challenge is that energy, transportation, and housing tend to be three that affect retirees the most.
Absolutely. Absolutely. Energy is fascinating to me. Housing, in the last couple of days, we've seen some interesting numbers. Housing sales numbers are down, especially in California. So that could be turning a little bit.
Exactly.
I'm surprised to see medical care.
Oh, you got me. I was going to do yes. Shocking.
Only up 2.2%.
Yes.
I think of medical care inflating at 10 and 15% per year.
Yes.
So if it's only up 2.2% per year, that's interesting to me. I'd love to know what's behind that number. And then commodities actually down, a little deflation on the commodities.
I bet you Amazon and Jeff Bezos and Warren Buffett would say it's us. It's us. Trump would say it's him. And you know that Trump did have a discussion with Pfizer, and they did reduce some prices of some of their medication. So there's been it seems like a real active movement to help push down medical costs.
I'm all in favor of pushing down medical costs.
Well, we still got more work to do on that. But again, so when we look at energy prices, that's one thing we do want to spend a minute at a time, of course. One of the things you're expert at, Stefan, there are many. Oil is one. So energy prices have been rising, and oil's broken some support barriers. It's made some new highs, and the question we always need to ask ourselves is this going to be the ultimate price for oil? Is this where we settle in at? Is this what's going to happen?
Oil prices are very difficult to predict, as I have learned in the past. I've been humbled by the oil markets and the natural gas markets dramatically a number of times. But what's interesting about oil prices to me right now is that while over the last quarter, oil prices were moving up, at the same time, the dollar was rallying. Normally, the dollar and oil prices will move inverse to each other.
Right.
So if the dollar were to turn around and begin to depreciate against other currencies, we'd expect oil to rally more. Which is something that's surprising to me. There's something else coming that's, I think, interesting, which is to take a quick tangent. We won't go too far on it. About 18 months from now, there's going to be changes in the rules around what kind of fuel all ships can use. And it's going to reduce the amount of sulfur that the ships can use in the fuel. So what that's going to do, it looks like what that means is refiners are going to have to use about 3 barrels of sweet crude, low sulfur, with the sour crude, which is high sulfur. So the refiners are going to have to adjust to this. What that means is going to be added demand for the sweet crude. And you see a lot of sweet crude coming out of the Gulf of Mexico, the United States. You see a lot of sweet crude coming out of the Permian Basin in the United States. But it looks to me like you're going to see price increases, especially from the sweet crudes. And that starts only 18 months from now.
Yeah, and we're seeing so much more production here in the United States relative to where we've been, that seems to be very beneficial for us, despite the higher prices at the pump, because it's a huge part of the economy that more jobs, high-paying jobs, that kind of thing.
Yes. We were also seeing, I think, interestingly, the the situation in Iran with the sanctions could lead U.S. oil producers to capture some of the markets that Iran typically feeds. We still trade West Texas Intermediate oil at a discount to the global crude, which is called Brent. Wouldn't be surprised over the next 18 months, for the reasons we talked about, for that spread to narrow, which could mean West Texas Intermediate crude rising.
So don't expect prices at the pump to plummet anytime soon.
I don't
Doesn't
think so.
seem likely.
Well, and gas prices at the pump and oil prices aren't as correlated as you think, because you buy the gasoline from refiners who have their own economics and their own limited ability to produce this stuff. So if oil prices go up and it doesn't go up at the pump, people are surprised, but they're not as related as you might think.
We could do hours on oil. We could
bore people for hours with oil.
All right. So global inflation. If you look at a chart of the world, the vast majority of the world, inflation is pretty calm. There are areas and pockets where you have inflation greater than 25%. Hello, Venezuela.
You're going to say Venezuela, aren't you? Oh my goodness! Wow.
Was it 1,000,000 or 1,000% inflation?
I had the same conversation with myself this morning. I think I saw a million
percent.
1,000,000% per year.
Inflation.
Yeah. So the currency is worthless.
Yeah. Right.
Yeah.
Good luck trying to buy a car or bread.
It's good luck trying to have a society. It is
hard.
Really sad what's going on down there.
Again, rampant inflation's one whole thing, which is interesting. And there's really, again, in South America, there's that component. There's also, excuse me, a few areas in Africa that have some problems too with inflation, which leads us to the inflation scenario conclusions.
Yeah.
There are three ways that we see this coming down. There's the good, there's kind of like, which is pricing pressures are easing, or like a symmetric level of inflation where the cost of living is going up on a balanced level, or bad, where the Fed outpaces inflation, increasing rates too much, causing an economic downturn. And thanks to our friends at Hidden Levers that, again, have a great technological resource, if pricing pressures ease smoothly, looks like the market, they believe, and it seems likely to us, that the market's up 10%.
Right.
Great. If we get a symmetric kind of a balanced level of controlled inflation, they think the market moves higher 5%, but if the Fed moves too quick, they see the market down 20%.
This Hidden Levers technology is really impressive, and those of you who are listening who are clients of the firm have seen this before. Those of you who are listening who aren't clients of the firm should see the technology, because it's amazing what it can do. It allows us to say, okay, we believe that inflation might go up on a baseline of 2.5%. What does that mean to the S&P 500? And you would need teams of PhDs and analysts spend weeks of time to figure this out. But we have software that kicks back and you think, in that case, the S&P 500 is likely to be up about 5% over the next year.
Right.
Well, what if you think that inflation is going to slow from today's levels and it's going to be about 2%? What's the S&P 500 likely to do? We think it'll be up on the order of 10%. And if inflation goes up to 4%, we think the S&P 500 goes down 20%.
Right.
What that allows us to do is position portfolios in such a way to anticipate the potential scenarios that people are concerned about.
Buy security, so we can figure out which security should do well and others. But so hopefully we don't net. Hopefully the Fed doesn't move too quick. That's the hope. So with that, that's the market outlook. That's the market outlook in 45 short minutes.
That was fun too.
It's a good time.
That was terrific. Next time we got to talk more about the girls.
Oh, my girls?
Your girls.
Talk about your son.
Well, we talk about my son. He just learned how to jump. He loves.
He
you can tell when he's happy now, because not only is he smiling, but he's jumping.
Does he have vertical leap similar to yours, or more?
Yeah. When I was 2, I'm sure my vertical leap was similar to his right now, but I hope it's better.
We need to track it.
We'll start measuring vertical leap already.
Well, thanks again for tuning in. Stefan, we'll be ready to do the next market outlook here in the next couple of months. Thanks for tuning in. Take care and have a great day. Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities. Member of FINRA and SIPC.